Yeah, so this is actually, I think, the third time I've covered it, and I think you guys might have talked about it before. I
Yeah.
was with Keystone as well. So we've been watching the company over the years. If you're not familiar with Plurilock, symbol PLUR on the TSX Venture, they are a multiple patent holding cybersecurity service provider, software vendor, and value added reseller. They operate in highly regulated industries, including healthcare, critical infrastructure, government and defense, and financial services. The last time we covered them was in June of 2023, with the main takeaway really being at the time is revenue growth was looking a bit better, it was looking positive. But to support the growth, they were diluting shareholders significantly. So let's see if that's still the case. Let's see if anything's changed, improved, got worse, so on. The stock is currently trading at 52 cents, down 20% year to date at a 30 million market cap. However, over the summer, the stock just skyrocketed to about $250 a share, but quickly came back down. Even on this chart, you can just see it's effectively a straight line over that week once it peaked out there. So very volatile stock, even if the year to date price change isn't that dramatic. So looking at the last quarter, Q2 2024, revenue came in at 12.6 million, 3.2% growth over the prior year. 80% of the revenue, however, comes from hardware and system sales, which is generally lower margin. 8.5% came from software licenses and maintenance sales, and 11.5% from professional services. The biggest change here is that shift up in the professional services by 98% to 1.45 million from 731,000, which is a good increase. It's a higher margin line, but it is still a small portion of the overall revenue line compared to the mass proportion of hardware and system sales. And they did note that this is something they are focusing on these higher margin activities to actually produce some sort of gross margin instead of just revenue. The company did do some cost cutting as well late last year with layoffs, resulting in lower operating costs of 3 million compared to 3.5 million. However, the company is still actually at an operating loss of 1.1 million, but that is an improvement from an operating loss of 2.1 million. So an improvement nonetheless, but it's still a loss ultimately. Further down, the company had a significant loss due to convertible debt and debt settlement, which are really one-off items that relate to the warrants attached to the convertible debt and the issues of warrants and shares to settle the debt, other type of debt. Non-cash, but they do dilute the company, which we will get into in a minute. The end result of all this is a net loss of 3.9 million or 11 cents per share. A quick look at the cash flows. The company is still burning cash, having an operating deficit of about 1.5 million, which needs to be covered by raising capital. They do not have the balance sheet to support a constant burn at this time. And they've effectively continuously done this equity raising, at least as long as I've been following the stock. The balance sheet at the end of the quarter is not great. It's not the worst thing ever. It's slight net debt of 0.1 million, but that's not really meaningful. It's break even pretty much as far as cash and debt goes. However, the company does have a poor current ratio of under 1 times at 0.76 times, which can indicate short-term strain. This is driven by the balance of receivables and payables, which they have highlighted as a risk previously. And they've actually, previously in April, they raised shares to lower the payable outstanding. So it is having an impact on their capital structure. The stock has previously gone already through a 10-for-1 consolidation, but the dilution has continued at a very rapid pace. So at the end of Q1 of this year, the company had 10.3 million shares outstanding. By the end of Q2, due to the massive share and warrant placement to cover that accounts payable or paid down a bit, by the end of Q2, the company had 43 million shares outstanding. And even since then, due to warrant exercising, the share count is nearly at 59 million shares outstanding, nearly 6 times what it was at the start of the year, which is just a massive dilution. And that is not really a sustainable business practice to keep on diluting, and it doesn't really create value for the shareholder. It subtracts it. Although the balance sheet should be looking a bit better once you see the Q3, as they have had those exercises, they should have raised cash. They should be able to pay down some payables. But this is your cause, is your shares have 1/6 the economic value of what they did at the start of the year. You own a smaller percentage of the company unless you are buying additional shares. So a positive point is they've had a couple significant contracts announced recently. They do really love to announce contracts, and I think they overdo. I think they should only focus on the bigger ones. But a couple of the bigger ones, which they did sign recently, was a 19.3 million US over 3 million contract over 3 years. with an undisclosed S&P 500 company to re-platform its cybersecurity operations stack. That's their highest historic contract act. So obviously, good thing to see. But it's really a one-off compared to some others. The second biggest, which they've had recently, and these would be in Q3 and Q4, is both these are in Q4. They had a larger 5.4 million Canadian contract with a law enforcement agency announced last week. So two larger contracts in Q4. They had a relatively slow as far as announcements go in Q3. But we will see likely those earnings in the next couple of weeks to see if they've actually been able to sustain any sort of revenue growth, as normally their Q3 and Q4 is a bit higher. They have a bit of seasonality, but it's not, since it is a contract-based business, as you can see on the slide right here, you do have lots of variable even year to year, quarter to quarter, just because of contract timing. So overall, the company's just not appealing in the time. The cash flow burn has resulted and will continue to result in shareholder dilution unless that changes, and it really needs to be stopped to have any sort of investment case as a long-term investor. Is you can't have constant cash burn dilution. It's just losing you value as a shareholder. The revenue growth hasn't been spectacular over the last couple of years. Yes, it's upticked and you got some higher margin, gross margin, but it's not like the spectacular growth. If you're issuing shares crazily like they have been, you need to have a high return on capital investment, which they just haven't. Q3 and Q4 are normally stronger, which could give a bit of insight into any sort of a turnaround coming. If that is the case, they are worse off than they were earlier in the year, I would say, but it's not exactly enthusiastic when you're seeing that level of dilution. The cost cutting and focus on high margins is positive, but it's just still so far off of being appealing at this time, in my opinion.
Yeah, I mean, I think it's a pretty easy equation there. You have some revenue growth, although even that has flattened, and you have negative cash flow for 6 straight years. And the only way to keep the business going is to continue to issue shares, diluting existing shareholders. And, it just, that's a recipe for a share price that's, not going to go up over the long term. They have to keep cutting costs and bring in better margin. It's nice to see their the professional services, which should have a better margin. They are trying to emphasize that. You got to keep doing that. But if you have to keep getting there by issuing more shares, you've already had a 10-for-1 this year. And Brett showed the increase in share count over the course of the year, just since that 10-for-1 is still, again, the same path, high dilution. So well, we'll monitor the company. We keep getting questions. We have a specific criteria. We want profitability from operations, and to grow that without dilution, you need per share earnings growth. We talk about this per share cash flow growth. It's difficult to get when you don't have cash flow, and then you keep increasing the share count. Those are two things that don't work for us.
I don't think that's going to stop anytime soon, even if, because like as you saw, the reason why they had so much dilution since the quarter ended is because their share price did skyrocket. And this is the issue when you have those warrants outstanding. If you do get some sort of a run as a shareholder, if you're a short-term investor, it can quickly disappear because those warrants get exercised, they get sold onto the market. And they do actually have, this is off of the end of Q2, it's probably changed since then, 87.5 million total shares diluted if you fully diluted the company. So there's still even room for them to further dilute under their current structure.
Yeah. And like we had a client like ask about this stock in February, and I gave them a very nice email, very long, spent some good time on it but like really, the conclusion that I gave her in February was, right now, I do not see positive trajectory with the business. What I would like to see is management be able to get scale where they reach break even. It might be very difficult given the low margins, as well as commentary that they have a path forward to increase margins higher. Until then, they will likely have to continue to issue shares, which will place pressure on the stock. And of course, that's what's happened. Like as well, I don't know if I just missed it, Brett, but like why did the stock skyrocket this summer? Like I was reading an article here, and like I don't know why it started in July, but I'm reading an article.
We can speculate, but there's a hell of a lot of promotion.
Well, yeah, and this is the thing. On August 14th, the company revealed that it had filed a patent application for its AI-driven cloud access security broker. Anyway, so all of a sudden they're like starting to talk about AI. It looks like, and then the stock had a big spike. So, anyways, I just thought that I'd throw that in there because I was just I was curious why.
It is curious. But I mean, you know what? We've had about 5 or 6, 7 companies that have tremendous gains over the course of this year as well, but they are still at those prices. That's,
and that's
the difference,
thing,
right? Like, you know, when you look at, when we talked about a company today, like they're, you know, you need to be able to sustain the gains, right?
Exactly.
And it needs to be backed up by something fundamental to be able to sustain those, make a new level, and grow going forward. If it's just promotion and fluff, even that's typically hard to see a share price do that. But that's how you got that. It made no sense fundamentally.
Because I guarantee we'll get a YouTube comment that's like, but the stock was up this amount. You know, like even on Sona Nanotech, we got the same thing. It was like, the stock was up this amount. Well,
and now it's down 20%.
Good luck with your money.
Exactly.
Mr. Stock was up this much. Yeah.
Exactly. Good luck getting out at that point.
If you're a trader and love the volatility, go ahead. But as an actual long-term investment, it just doesn't work.
Anyways, I've beaten the horse dead here, but let's move on.